Welcome to Property Banter by Pinnacle Buyers Agents. My name is Michael Ležaja, and in today's episode, we have Aaron Whybrow from Strategic Mortgage Brokers here. Aaron is an absolute gun mortgage broker, and today's episode, we're going to be talking about whether or not borrowing cap is a myth. This is a great episode, and if you're a property investor, whether you're starting out or you've hit your borrowing capacity, we're going to be breaking it down today and talking about different strategies that you can use to ensure that you continue to borrow and buy. We hope you enjoy this episode. Let's go. Welcome, Aaron.
Oh, thank you for letting me come on.
No. Yeah. It's great. You had the red-eye flight this morning.
Absolutely. Oh, I had a sleep, so
yeah,
it wasn't really a red-eye flight when I had a sleep. So
that's good, mate. That's good. We're very, very excited to have you on the podcast, and we really want to talk about a lot of the things you're seeing, and in particular, talking about how many investors you come across that may have one or two or three and seem to get stuck, and they are struggling with the strategy needed for them to make that 1% and have five and more properties. So what are a lot of those mistakes that, those investors that have one or two only or three only, what mistakes are they making? And how are you helping a lot of investors get to the 5, 6, 10 mark?
I think a lot of investors want to do property investing and they focus a little bit too much on the property. And I know you guys will probably say that property is a really cool thing to look at, but I really like to break it all down back to the lending and having a lending strategy, and not just a lending strategy that purchases your next property, because that can just get you going. It doesn't get you the building power that you need across multiple properties. So when people come to me that have 2 or 3 properties, some people get stuck with just their owner occupied and one investment, and then they might get distracted with babies, kids, family, all that sort of stuff. Some people just get stuck because it could be their income, it could be some of the choices they made. The other people that get a little bit more stuck is someone that is earning some decent income. They believe their friends who came over for the barbecue are earning similar income and keep buying property, and they just feel like, what the hell's going on? I can't get to the next one, but everyone else seems to be getting to the next one. There are obviously some outliers where they don't have their income anymore and they still want to buy property, and there are some unique ways that we can help those guys. But sometimes it's just they've had enough, and it's time to probably relax and let the market do the heavy lifting. But
100%. So there is ways in which, so you could have, the old compare the pair ad. So you can have two people, you can have two couples, right? Both on the exact same income, and just like you're referring to at the barbecue. And one couple can go a lot further because they have the right people in their corner who understand the strategy required from a buyer's agent asset acquisition standpoint, but also from the main thing, from the lending standpoint, that allows them to be able to borrow more. Because let's face it, property, the more good debt you can acquire, the faster you will achieve that end goal, right?
Yeah, and it's really fascinating. I get to see people's credit files. And this is a really fascinating thing, because when you look at people's credit files, when people have credit cards, personal loans, car loans, it will decrease their score. Whereas I can do multiple loans for people that actually have an outcome of a property and their score goes up.
Yeah.
Yeah, because it is about that good debt, bad debt thing. And then also when you go further from the credit files into the lending strategies and how to get past some of the problems, like we have to use the full gamut of lenders. We have to understand where people want to go. Like they might have a goal of a passive income of $150,000, which maybe it's not in property at the end, but they've been able to cash out and get, say, $3 million, returning a 5% yield, $150,000 of income a year off that. But they only have $1 million worth of borrowing capacity. So we've actually got to get them past that million to the 2 million, to the 3, to the maybe they need $3 million worth of property, but that doesn't have a debt on it. But to get that, they may need $6 million to then sell some down. So these whole things about how you acquire a property, what the lending looks like, where do we put our lending? There's 3 major areas that we can borrow in the Australian market. So we can borrow in our own name, which is the most common thing. The most common thing is people will just buy in their own name. They'll have this thing in their mind that they can get some tax breaks. So I'm paying the government too much money.
Everyone's got to stop that. This tax break, the I invest just to save tax, 3 ways to save tax or whatever it may be. That's the biggest no-no.
And that's the clickbait, right?
That's it.
When you peel behind how to pay off your owner occupied mortgage with the tax man, like that's all just in property investing, probably done to bait you in. And tax is an outcome, not a strategy.
Yep. And that's what us sophisticated investors know that are in the game. But these people advertise to people that aren't in property investment, and they're just looking at just getting anyone who wants to save a little bit on tax.
That's right.
But what everyone needs to do is have a look at what's your desired end goal. Is it an early retirement? Is it the 150K passive income? And focus on achieving that goal. Tax is it's something that's there. And if you're making money, you're paying a bit of it. But at the end, that shouldn't be our reason for investing.
That's right. And that's where I see a lot of people get capped out because they don't want to pay an accountant's fee. They don't want to set up a structure that could cost a few grand a year. They are used to paying their $300, $400, $500 tax bill, but now we're going to do some more advanced strategies around where we can hold debt, which helps us borrow more.
Yeah.
And we got people that they always focus on their personal life, personal name to own debt. And when they focus just on that area, they can get stuck.
Yep.
Then most people will start to go down the line of the self-managed super fund because it's quite known that it's got its own borrowing capacity, it's isolated from your own personal life, but has some quite ninja ways to use future income and a few other things to be able to get borrowing capacity there. So then it's the personal life, they've capped that out, then they go to the super, and then typically they may come back to their own personal life after 6 to 12 months of distraction with the super fund, hoping that something's changed here.
Yeah.
And then they still go to the barbecue. They go, cool, I've done the super, I've done my own name, I'm still stuck. And these guys have just bought like 10 properties. What's going on? I've got the same income. So then that's where the third area of investing comes in, where you've got your own name, self-managed super funds, and then entities. Now, I put entities there because it could be because there's a bit of extra advice around that stuff, right? So super is pretty straightforward. It's just a couple of companies and a trust deed, and it's quite regulated, and it's fairly not necessarily always off the shelf, but it's nearly off the shelf with accounting and planners and stuff. With the trusts, that's where we get a little option. So there's things that fancy names like discretionary trust, unit trusts, hybrid trusts, family trusts, company as a trustee, individual as a trustee. So that actually requires some accounting assistance and tax and what happens in different states. So I've just put that in a bucket of entities.
Mm-hmm. And that's what rich people go to, right? So that's what rich people go straight to. But a lot of investors are making the mistake where they max out their personal name, then they'll go SMSF because they hear everyone's doing SMSF and it's got its own serviceability way in which it services. So they go the SMSF and then they're like, oh, I'm tapped out. What do I do now? Yeah. Oh, you're telling me you can get serviceability if I get a trust. That's what I hear commonly. And then
very common.
But they've already maxed out their personal. And then it's about undoing some of the purchases or transferring it over and so on just to get that serviceability back. Whereas what you should be doing is when you're starting a portfolio, know where we're going, know our end goal, and let's work on the entity structure straight away.
Absolutely. So when you borrow and you look at the complicated calculation that entities usually sparks, because it's easy to say your own name and super is so separate, but entities needs, especially if you're buying residential property, it needs personal borrowing capacity to get there.
Yeah.
So if you've ever heard someone go, oh, well, we won't invest in trusts and companies until we've run out of borrowing capacity. Well, that's the biggest fee out there. You can't invest if you don't have borrowing capacity. You can't invest if you don't have a good income. There are some outliers about how we can deal with things with commercial and other types of products, but if you've got a good income and you've got too much in your own name, because your own name, the calculation in trusts always comes to your own name, your own personal borrowing capacity, living expenses, children, debt, private school fees, all the stuff that comes in there, plus the property, debt, value, and rent of the property that goes into the entity. That has to pass the calculator. So you might have built up your own name with lots of property and stuff like that. But you've really got to then engage buyer's agent like yourself to understand what has my property portfolio done? Is there going to be more growth in some of these properties? Which properties could I let go of to be able to repay debt in our own name, to then look at structuring the debt into trusts and entities and all that sort of stuff. So you highly respect people that have built a property portfolio up in their own name. I've had people come to me, they've got 9 properties in their own name and they're stuck. But with a bit of elbow grease, a bit of work, a bit of understanding what's going on with those properties can make the big difference of potentially even selling down. Oh, that's a dirty word. We shouldn't sell our properties, right?
No, you shouldn't. But we want to keep acquiring, right? That's the goal. But at the end of the day, sometimes to clean it up, it's necessary. Also, there will be properties that aren't performing or that are in areas that have considerable growth. You can cash in on that, clean things up, and essentially take that, one step back to go 2 steps forward.
Absolutely. Yeah. And I think the other one that we've had a lot more conversation around is, can you move your properties from one place to another? And the answer is yes, but more commonly we find a bit of extra information around the property, the location, the future outlook, whatever the metrics are around it, whether it's days on market, whether it's plateauing, all those nice funky words that people use around assessing property. Most commonly we find people will sell out of their own name to then rebuy in trusts. There is a few outliers around whether the property is a star property, a family heirloom, or whatever it is that needs to be moved from their own name into a trust. It can be done, but there is a bit of cost associated. And then there's a really funky topic around how you can move properties from trusts to other things and all that stuff, which is where I geek out a little bit.
Yeah, 100%. Well, let's talk a little bit about that. So we were just chatting earlier in regards to one of the situations where you had a client and you helped them get unstuck. Let's give everyone a good example of how, you worked with that particular client in, helping them move on to, sort of get some clarity around their lending and be ready to be able to take the next step when they've obviously they've hit a cap essentially with their previous broker or the bank, and you've helped them, move forward.
Get to the example in a moment, and it comes down to the decisions that people make, right? So if we decide that we're going to go to ANZ and that's who we're going to go to all the time, you're going to be only exposed to their policies and practices. And if most people that I'm seeing that come to me are stuck with one major bank, so they've only had one set of policies, or they've got two minor banks, maybe an ING, maybe a Bankwest, if I'm allowed to name banks here. And they can be like a little bit more conservative on their assessment. So you've got to think about how you're going to organise the banks in the right way. The most typical people will go most restrictive to most lenient lender. Then we've just got to vary the ownership along the way so that we don't have to go to the most lenient lender that's going to cost us and tear us a new one at the same time. Like there's still people buying their last property with these high interest rate lenders just because they're going to give them the money, but then they screw their cash flow. So people that have come to us to get unstuck, what typically happens is there's a combination of factors of needing to get the next purchases in structures, getting the next purchases in super funds, and having an analysis of their property portfolio with the team that they need around them, buyers agents and accountants as well. Because if you go and sell stuff, you've got to know what the tax implications are. If you're going to change things from one name to another, you're going to have to understand those implications, not from just the accounting side and tax side, but from the market. You don't want to be selling a property and then tomorrow it goes up by $400,000 and go, what the hell have I done? A couple of really cool items of unstucking people or even just getting them going. One of my clients, they came to us, they had an insurance claim sitting in their bank account ready to go. I think it was over $1 million. They wanted to buy a property. They weren't earning income at the moment. Their wife was earning income that was taking care of the family and the expenses and all the stuff was all cruisy. So they wanted to deploy this capital. So they were able to end up with 12 properties in the end. And the way that we did that is that we were able to look at residential properties through the lens of commercial lending terms. So the multiples of tenants that this client wanted to have the income, because he didn't have the income now, he had the capital but not the income. So the client went out and bought unit blocks. Now, I'm not saying that anyone should buy unit blocks. It's just a thing. It's just a property, single occupancy, commercial, whatever. It's just a thing. So we were able to do a thing called lease doc lending. And basically we got the tenants' leases and we presented that to the bank and that was enough for the income. We didn't get 90% lending. We didn't get 100% lending. We got 50% lending. And you can just imagine, like, if you've got 4 tenants and then you're getting another 6 on another block and you've put a 45% deposit down on a property, that thing's going to, like, throw some cash at you.
Yep.
And that's the thing, like, there's a way to make every property positive cash. Just put enough deposit down.
That's true.
Right?
That's true.
And the easiest way to get rid of your borrowing capacity problem is to repay some debt.
That's true.
It's a
very simple way
what
that
is it? We're talking about selling properties, which is dirty word, right?
Mm.
And we're repaying debt. Oh my God, we want interest only all the time, right?
Yeah, we want more debt.
Yeah.
It's funny how it works.
Yeah, so we got those outliers where we can do lease stock loans and things like that to help overcome personal servicing capacity. But that's a product, not an entity or anything like that. Other people that have got stuck, they might have bought a lot of property in their own name.
Yeah.
And they still have an owner-occupied mortgage. So then when we get to a bit of a cap of 1 or 2 banks, we have to then start moving to the majors and the minors of the banks. So I'm not a big fan of tier 1, tier 2, tier 3 lenders because I can make a tier 3 lender in the traditional definition cost less than CommBank.
Really?
Yeah.
This is awesome. Can you elaborate on this?
Oh, you
'Cause
want that one?
I'm dying to hear this.
So your tier 3 lenders typically have 3 product lines: the prime, the near prime, and the specialist.
Yep.
And what they do is they help with people with short-term, self-employed, credit problems, arrears, all the stuff that people go, oh, that's a bit dangerous, right? But they have a product line that's prime. So you might get the bank brand of what it was, a tier 3 lender, but they don't load for interest only. They charge the same as principal and interest. They have minimal fees. They don't charge an annual fee in most cases for an offset account and multiple splits and stuff. Maybe they might charge $10 a split or something like that. They might not have any application fees and you just have to pay the valuation fee. But at 80%, like 80% with one of these lenders, we're looking at even just over 6% for interest only or principal and interest on an investment property. So, and CBA or ANZ or anyone can still be over 6% for interest only at the moment and throw an annual fee. And yes, you can get all the bells and whistles and get a great app on your phone and stuff, but I don't think a fancy app should stop you from property investing. So my tier 1, tier 2, 3, I usually just the majors and the minors. Like there's a regulation set on the major banks, 3% buffers and all these other stuff, and then with the ones that are regulated more about ASIC, that like we can get 1% buffers, no buffers, 2% buffers, which allows us to get the borrowing capacity up. Set of borrowing capacity, like we might go to Macquarie and it's decline because the calculator doesn't work. Go to CBA and it only just passes. And then we go to another bank like Resimac, for example, and it passes by $14,000 in surplus money. Same numbers, same incomes, same everything. So we've had a client come 8 or 9 properties in their own name, wants to get the next property. So we have to go to the minor banks and look at putting into structures. And then see what the assessment is on the past, on all the other properties that they've got.
Yep. So these lenders, these specialist lenders, are obviously they've got their credit from wherever they get their money from, right? Mm-hmm. And are you saying,
which is sometimes the major banks? It's a bit incestuous.
Let's not start in how the Reserve Bank cash rate.
Okay. All right.
There's so much we can talk about here. But what I'm trying to work out is, how are they cheaper? They're just not passing on those extra fees. So you're saying the big banks that probably have the most access or the most liquid and have the most access to funds tend to charge us the most fees associated with our loans? Is that what you're telling me?
If you are not needing the specialist stuff like alt doc, low doc, go, all bad credit, things like that, sometimes it can be direct comparison that a minor bank will be cheaper than a major bank.
Wow, that's amazing.
But everyone has their place. Every bank has their place. Like with how they assess between all the policies. So you're probably alluding to why would one bank be different to another? It's all about competition. You can't just compete on price. So if you compete on price, we both know it's a trail to nowhere. Everyone's then charging nothing, right? And what are you actually getting in the end? So it can't be just on rate. A lot of people do come to us and they go, oh, can I have the best rate? Well, what have you Googled recently on the best rates? You probably should go there because most of the banks that have the best rates that they want your firstborn child to be able to get it in the first place. Whereas if you want a strategy, and you build wealth, like let's just not go there. it's all about the policy about how much lending that can come out. So if you're a minor bank and you want to compete with CBA being the largest lender in the country, you're going to have a different policy. You can't just have a different price. You've got to have how much we're going to assess existing debt, how we're going to assess our credit cards, how much rent are we going to accept on there? Are we going to have negative gearing in this or that? Are we going to load up some? It's really around how they get the existing debt. Do we need to incorporate investment property costs, right? So some banks will take 80% of the rent and not need to worry about the investment property costs. Some banks will take 90% of the rent and they need to know all right down to every single nook and cranny of property management fees through insurance. So it's all about the policy. And when you and yes, the banks compete, but I would say it's even deeper than that for a property investor. It's when you use the bank. When are we going to use CBA? When are we going to use Resimac? When are we going to use First Mac? When are we going to use ANZ? Because they all compete, but now we can have a strategy about when are we going to use them in sequence.
And the best investors do that. So for everyone at home, the most important thing is that you use the banks against each other. You use a mortgage broker to actually utilize a certain lender at a certain period of time in your portfolio to give you the best advantage so you can scale your portfolio. The people, and the biggest thing that I want everyone to take away from this is that you don't stay with one bank. No. Just because you bank or your dad banked with Westpac or whatever it may be, that's got to stop. You need to use a broker, you need to have a strategy, and you need to play the banks off against each other at different times and use it to your advantage. That's it. Simple.
You can make it easy on yourself when you can switch banks around. So a lot of people might think, I'm gonna move from CBA to St. George, right? Yeah. And then they'll up and move absolutely everything to St. George when you don't have to, right? Personal share?
Yeah.
I've kept my transaction account with CBA because I didn't want to be bothered changing my direct debits, changing my payment schemes, BSB numbers, all that stuff. Left it there.
So they're debiting your CBA account?
Well, my personal account has been there for ages.
Yep.
I just don't want to spend the time changing everything.
Yep.
All my payments. So I've just left it there. But I've got my lending with 4, 5, 6, 7 other banks because they can have a direct debit relationship with their own offset account. So I might go to St. George and I have an investment loan and I'll have an offset account there. And that's cool, no trouble. I might go to another bank and that's got a similar thing. But I just didn't want to be bothered changing my own personal bank account. So you don't have to up and move absolutely everything. When you are investing, $1 from one bank is the same value as $1 lent from another bank. Yeah. It still buys the same amount of house. So let's use the policies to get the lending. Yeah. And then focus on what's more important, which is generating deposits and cash flow.
Yep, 100%. Let's jump on to entity lending, right? So not utilizing your personal name. Back when I started, I bought my first home buyer scheme and you got into property in your personal name and there was plenty bought in my personal. I think I bought like 6 in my personal name. Lending was a little bit easier back then. But now times have changed and a lot of people are doing the rent vesting thing and the importance of entities with regards to servicing is more important now than ever. What sort of advice do you have to give for anyone starting out now, looking to build a property portfolio? Do they go to trust sooner? I mean, what do you recommend?
Yeah, so the examples I see on a day-to-day basis, because we deal with a lot of people that are multi-property investors and that are starting out, and the really cool thing about talking to investment specialized mortgage brokers is that you can get some tips and tricks from the top investors and what potential problems they've found along their way before you start. And a lot of people haven't thought about the company or the corporate trust structure early enough in their property portfolio. I would go as long to say is that if you've only got anywhere between $500 to $1 million or even up to $1.5 million worth of borrowing capacity left and you haven't had the conversation about a trust with your accountant and how it affects your borrowing capacity with a broker, you shouldn't go buy any more property until you've had that conversation, because that's the game changer. Because you could go out and buy a $1.2 million property with your $1.5 million worth of borrowing capacity, bit of equity from another property, but what do you do after that? And that's where it is. And that's where I'd say if you are thinking about all 3 areas of investing, your own name, super funds, and entities, you'll never hit that borrowing capacity cap.
Yeah.
because you know how to avoid it.
So are you saying
Yeah. There is no such thing as a borrowing capacity cap. There is
that's
no
what
such
I wanted
thing.
you to say?
Yeah.
That's what I wanted you to say.
Yeah. There is no such thing as a borrowing capacity cap because it comes down to what you are willing to choose. Are you choosing what we were saying, those words before, selling, paying down debt? If we're going to start out investing, we're going to be using structures way earlier than we think. And we're going to be assessing the properties and where we want to put the borrowing in collaboration with buyer's agents closer. Yep. We will probably choose at times to put the property in our own name. So I'm not saying don't put it in your own name. Collaborate with the team around you to make the right choice.
Yeah.
We will probably put a crap ton of properties in entities and trusts and stuff as it gets to your goal. And that brings it to what is the other problem that we find all the time when we're unlocking borrowing capacity is that people just need to know what they want.
Yeah. So the biggest takeaway I think for everyone at home is the old, what is it? Planning
prevents.
Planning prevents. I was going to go.
Piss poor performance.
I was going to go with not planning is planning to fail.
Oh, yeah.
Or something like that. Yeah. But we'll go with your one.
Oh, okay.
We'll go with your one. And they're both correct.
Yeah, yeah.
And at the end of the day, I think, what I was saying earlier was a lot of people buy that one property because they've seen an ad and they want to tax save, right? And then they get a bit of equity and they buy a second and they're maxed out. But all of a sudden, they've had a mindset shift because they've now been a landlord or property investor and they are comfortable with investing. They're comfortable with that little bit of debt and they've seen the equity happen. And now they're like, well, hang on. I want to buy 4, 5, 6, 7, 8, 9 or whatever, or I want to get to 5 mil, or I want to get to 10 properties in, or I want to get to 150K per annum, cash flow, passive income. It's too late then, and then you got to unstuck yourself. So I think what I'm taking from this, if I'm correct me if I'm wrong, is that you need to plan from the start.
Yeah, planning. So give everyone some comfort. It doesn't matter where you've got to in your property portfolio because there's always a way to do it. Yes, unstuck or prevent to be stuck, which is what you would do when you're planning. So planning out how much property you want, planning out how much income you want, understanding that if you're in the now position and you're in the retirement position, there's typically, I find a lot of people will talk about this point here. I don't know what point it is. It could be 50, it could be 40, it could be 60, it could be anything that they want to slow down. So we've got this point here and we get retirement here. We've got our vehicles of personal name, trusts and super. So we might go, cool, I'm going to make a decision here because I've got 20, 30, whatever years left to retirement. Then I'm going to whack some stuff into super, because that will kick in when it retires. So we'll just lock that away, bed that down, all good to go. Then they have a goal that sits in the middle, goes, I want to stop working. I want to go half-time. I want to go traveling. I want to do something. So now we've got this period of time with 100% income to be able to do stuff. Then we got this time to this time with a little less income to do stuff. So now whatever the time period is doesn't really matter. You can change the time period too. Don't think your goals are set. You can flex and adjust to whatever life throws at you. But if you've got this point to this point understood, you've got this point to this point understood, and you've bedded some stuff away that can kick in at retirement, you don't have to go as hard. So the goal may not be as big as you think.
Yeah.
But if you've got only $1 million worth of borrowing capacity left and you need to build a $10 million portfolio, you're going to need some tips and tricks up your sleeve to be able to do it, and a bit of time.
Yep. And the best people to get that advice from are people like yourself who understands lending and how to work on those structures, a good buyer's agent. Having people around you that have achieved that already is obviously super important because, learning from someone who's actually done it is the best way to get where you need to go.
Yeah. I don't think there's many mistakes you can do. There's problems that happen, and you've just got to deal with the problems and learn from it and move forward from there. But if you've got too much property in your own name, there's a way to fix it. If you've got
the fact that you've already got too much property in your own name, I'm kind of be proud of yourself. That's great,
right? If you've stuck on the borrowing capacity and you have to change brokers, change whoever you need to change to help out, accountants, whatever, go and find the information. If you feel you're stuck with only one bank in your portfolio, you need to talk to a broker straight away. If you're stuck and you're looking to sell and then buy more, you need yourself to help with the buyer's agency to understand what's going on in the property portfolio to move forward and have that extra. You got the lending problem, you got a solution to the lending problem. I now need to know what the properties are doing. Cool. I've got the property problem. I now need to talk to the accountant and understand the tax implications of this decision I'm going to make. And you've got to take a breather sometimes with property, right? Yep. You can acquire, and then when you...
It's an addiction.
Yeah.
We got real problems over here. This is what we love.
But it's a great asset, right?
Yeah.
It's probably one of the up there asset classes. There's not many other assets outside of property that a bank will throw a 30-year mortgage on.
No, or give you that much leverage.
Or give you that much leverage.
You can't get a margin loan with 20% down.
Yeah.
5 times leverage.
But this is the thing. Like, how do you, you can't get away from a 30-year mortgage on a property. Like, how the hell? Yes, you need to diversify. Well, maybe. Because the banks are certainly probably not diversifying if they're throwing 30-year mortgages on loans, on properties, right?
Yeah, 100%. I think it's the number one asset class, especially Australian property, compared to what's going on in the world and every other country's structure. I think, the US is down, Canada's down, New Zealand's down, Australian property bucks the trend and the way it's set up. And we're not going to go down the government rabbit hole and how it's all working because I've seen many, many different opinions on that. And that's not what this episode is about. But there's many, many factors that contribute to property being the best asset class. But before we go, I want to talk about a related industry that is super important when scaling your portfolio that I think everyone at home really needs to know. Obviously having a good broker is super important. Good buyer's agent, having people around you that have that experience, but having a good accountant we were speaking about earlier.
Yeah.
How does one out there find a good accountant that understands property investment? I think that is probably the first point, isn't it? Finding a good accountant that is a property investor.
Well, I suppose we both say that when you're finding the right buyer's agent, you want someone that's investing, right? You want a broker that's investing. And you want both of those people to have a team around them because you can't be everywhere.
Yeah.
Yeah. So, cool. Then the accounting piece is such a critical piece because people will take that gearing and want some tax benefits from property. That comes into the accounting world. We go down the line of self-managed super funds and entities that isn't a broker's domain except for the lending. And with the buyer's agent, it's more about we get the right property for the right area and get the right name on the contract, and not to make it too simple. But we need the accountant to help out because there's when we earn money in Australia, we have to pay some tax on it. So we need to structure it correctly. So we need the right accountant. And the right accountant, you can take the same criteria looking at buyers, agents, and brokers. Have they got an investments? Do they invest? Do they have a team? Can they write accountant's letters at times? Because you might have a self-managed super fund and the bank asks for an accountant's letter. And some accountants are not writing letters anymore. So you need to find one that's going to help you with the lending. We need accountants to set up structures at the right time and not going down the line of run out your borrowing capacity first.
Yeah.
And we need accountants to collaborate with both of us. It may not be every day.
It's a collective team effort.
It may not be every day, but what's the headwinds? Self-employed people especially, we're going into this period of tax returns for the tax year just passed. And then when we cross over the Christmas barrier, we're going into sort of that planning phase to go, let's not pay too much tax, but I would say let's pay the right amount of tax.
Yep.
And what does your profit and loss look like? What does your income look like, and is there a way that you can earn the extra $5,000 or earn the extra $10,000 to make your tax return get to where it needs to get to in comparison with the previous years, or in conjunction where you're at, utilizing a lot of other banks' policies that rely on that tax planning aspect of where your businesses are at. So self-employed entities, accountants' letters, making sure you're getting the right structures up and going. And then collaborating with the buyer's agent for which state, because that could change the type of structure, and also being able to just be available to pick up the phone, talk to you as a client, and talk to us as the broker and agent.
A responsive accountant. But I definitely have noticed a huge difference between accountants. So speaking to an accountant who is a specific, I really love stock market, I don't do property. That is not our type of an accountant. They will never understand what we're trying to achieve. They're not active in the game themselves. They don't understand how it works on this side. I think that you need to be super cautious about that because they just don't get what we're doing because they're not doing it for themselves. And I think that's very, very important to have that mortgage broker who is an investor themselves. They know what you're trying to achieve. They understand the tricks with lending. Buyer's agent, same thing. Accountant, same thing.
It's a big space. Accounting by itself is a big space. You may need that accountant that's a stocks expert at some point. You might need it's a bit like what piece of advice are you getting from someone? If you're wanting to get fit and you've got the fittest guy at the gym going to train you, but his money's all over the place, you're probably going to take his fitness tips, probably not his money tips.
That's so true because I do get money tips from my trainer as well.
Yeah.
Yeah.
Maybe he's an investor. What's the background, right? So I'm not saying that everyone that's fit doesn't have money. I guarantee you there's a lot of fit people that have a lot of money, right? So it's an analogy to understand who you're getting your advice from.
100%. It's very, very important. So in summary, there's no borrowing cap.
That's right.
There's no borrowing cap. We definitely need a good accountant that's property focused. We need a good mortgage broker that's a investor themselves. And we need to not show loyalty to one particular bank. We need to utilize different lenders at different stages of your portfolio build.
That's it. And we need to dig deeper. It's what you're willing to make a decision on to avoid the borrowing capacity, to not have a borrowing capacity cap. You need to dig into deeper on how you manage the cash flows of your property because lending can be available and you need to be able to have a plan on generating those deposits.
Yeah, and I think a lot of people are turned off from going the entity route because they're like, oh, hang on a second, you're telling me I've got to pay the accountant to do the financials for that year and that's going to cost me X amount. Well, let's not look at what it's going to cost you to set it up, what the ASIC fee is and what the accounting fee is. Let's look at what the opportunity cost is.
That's right. And if you're going to pay a couple of grand to earn 50 grand, I would do that every day of the week.
100%. That's exactly what it is. Aaron, thank you so much for joining us today.
No worries. Appreciate it.
That's Aaron from Strategic Mortgage Brokers, and he is a specialist when it comes to investment lending, and he's a property investor himself and knows his stuff. I hope you got a lot out of this episode. Please like, share, and subscribe, and we will catch you next time on Property Banter.